Good day, ladies and gentlemen, and welcome to the Q1 FY23 earnings conference call of Fairchem Organics Limited, hosted by Valorem Advisors. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anuj Sonpal from Valorem Advisors. Thank you, and over to you, Mr. Sonpal.
Thank you. Good afternoon, everyone, and a warm welcome to you all. My name is Anuj Sonpal from Valorem Advisors. We represent the investor relations of Fairchem Organics Limited. On behalf of the company, I would like to thank you all for participating in the company's earnings call for the first quarter of financial year 2023. Before we begin, let me mention a short cautionary statement. Some of the statements made in today's con call may be forward-looking in nature. Such forward-looking statements are subject to risks and uncertainties which could cause actual results to differ from those anticipated. Such statements are based on management's beliefs as well as assumptions made by and information currently available to management. Audiences are cautioned not to place any undue reliance on these forward-looking statements in making any investment decisions. The purpose of today's earnings call is purely to educate and bring awareness about the company's fundamental business and financial quarter under review. Now, let me introduce you to the management participating with us in today's earnings call and hand it over to them for opening remarks. We firstly have with us Mr. Nahush Jariwala, Chairman and Managing Director, and Mr. Rajan Jhaveri, Chief Financial Officer and Company Secretary. Without any further delay, I request Mr. Jariwala to start with his opening remarks. Thank you. Sir.
Thank you, Anuj. Good afternoon, everybody. It's a pleasure to welcome you to the earnings conference call for the first quarter of financial year 2023. I hope that everyone is keeping safe and well. This is our first earnings conference call in a very long time. And the interest of some of the people who are probably new to the company, in first phase, I'll give you a brief overview of the company, after which Rajan Jhaveri, our CFO, will brief you on the financial and operational performance of the quarter. Fairchem Organics is engaged in business of manufacturing of oleochemicals and nutraceuticals since last 25 years. Oleochemicals means the chemicals derived from vegetable oils. The company's key oleochemical products include dimer fatty acid, linoleic fatty acid, monomer fatty acid, and nutraceutical products include mixed tocopherols and sterols. Nutraceutical falls in broad guidelines which are part of vitamins. Mixed tocopherols is an antioxidant which is used in actual consumption. It can be used as an antioxidant or it is used as a raw material to manufacture natural vitamin E. We have a state-of-art manufacturing unit in Sanand, Gujarat, and which was set up in the year 1995, and over the years it has gone through various stages of expansion, backward integration, debottlenecking, technological advancements, energy savings, and in the process we have created a world-class facility. Over the last year or so, we have expanded our capacities from 45,000 tons to 120,000 tons currently. Our expansion has got a little bit bumped between 72,000 to 120,000 tons because of COVID, and due to which reason certain critical equipments were not able to reach us on time. But now all the expansion is over. Please note that in our case, the capacity is measured in terms of input of raw materials and not based on the output of final product. This is something similar to Reliance's refinery, which is always measured in terms of input of crude oil. Same way, our things are also measured in terms of input of raw materials. We have done the capacity expansion utilizing minimum capex, and which also was funded through which was funded 100% through internal accruals. Fairchem today is manufacturing in India of linoleic acid and dimer fatty acid, which comprises major part of our revenues. And in fact, in dimer fatty acid, we are the only manufacturer in India. Balance is being imported. And as regards linoleic acid, we are also the only manufacturer in India. A pseudo linoleic acid is being manufactured by a couple of other players. The products what we manufacture find application in paints, inks, amides, cosmetics, lubricants, etc., whereby our product portfolio, main product has application in different large number of industries. The mixed tocopherol concentrate and sterol concentrate of nutraceutical stream is being used by the FMCG companies, which we are currently exporting to US-based companies since last more than 20 years. Company has also finished a plan for forward integration, whereby we'll be further upgrading our mixed tocopherol streams to manufacture tocopherol 50 and a product called sterol 90, which goes in making of corticosteroids. At the same time, as an offshoot or as a byproduct, a product called methyl ester will also be getting generated. In generic name or a common term, it is called biodiesel. And another co-product which is coming out of our dimer fatty acid product stream called monomer fatty acid is also going to get upgraded for manufacturing of stearic acid and isostearic acid. Isostearic acid will be manufactured for the first time again in India. This is the story about the company in brief. Now I'll hand over to our CFO to brief you on the financial performance, after which I'll give you the operational highlights of the quarter, and then we can have question answer, whatever questions you have in mind.
Yeah, thank you, sir, and good afternoon, everyone. Let me brief you firstly on the financial performance of the first quarter of financial year 2023. The operational revenue for the first quarter was about rupees 225 crores, which grew by about 62% year-on-year. EBITDA reported was around INR 40 crores, a growth of approximately 22% year-on-year, and the EBITDA margin stood at 17.77%. Net profit after tax reported was around 27 crores, a growth of approximately 21% year-on-year, while the PAT margin was 12%. On the operational front, EBITDA margins improved during the quarter due to company's effort of containing raw materials costs and also to a certain extent due to economies of scale kicking in due to the higher volumes on back of higher capacity utilization of the new plant capacity. The company has completed its capacity expansion, and the increased capacity in terms of throughput of raw material of 1,20,000 metric tons per annum was operational now as at the end of June 2022. With this, we can now open the floor for the question and answer session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Raj Shah from Stetheros LLP. Please go ahead.
Yeah, hi. Good afternoon, gentlemen. My first question is that we have done from 36 to 38% of gross margin in Q1. So I want to understand that is it sustainable and can we just grow forward from those current levels?
Can you repeat it, please? Your voice is getting distorted. If you can repeat the question again.
What is sustainable? What did you ask? What is sustainable?
Yeah, am I audible now?
Yeah, now you're properly audible.
Yeah, great. So my first question is that we have done gross margins holding around 36 to 38% and EBITDA at around 17-18%. So my question is it sustainable and can we just grow from the current levels from in the coming quarters?
Yes, this margin we feel will be sustainable because of two reasons. One is the economy of scale which will be kicking in, and second thing is because of the forward integration of the two product streams. So overall, we feel fairly confident that this margins would be sustainable in long run.
Okay. And what proportion of our raw material is derived from soybean and sunflower oil, as they are our major raw material source?
To be frank, we can process multiple raw materials coming out of soft oils. Typically, soft oils are oils like soya, sun, corn, rape, canola, rice, groundnut. So, soya and sun being a major raw material, we are always eating a soya sun, but we can also utilize other raw materials and which we are using.
Okay, but if you could just give a sense on, let's say 60%, 50%, 40%, that will be really helpful.
Yeah,
just a ballpark number.
Yeah, you can say around 50%.
Sorry, about?
About 50%.
About 50%. And now that we have completed majority of our capex, can we expect the capacity utilization to be, let's say, by 70-80% by, let's say, FY23? Is it a fair? Is it a fair assumption?
I'll tell you one thing. I'll explain you one thing. Typically, in a specialty chemical industry, the time you think of capacity expansion and the actual capacity comes in place is minimum 3 years. And as a company, we prefer a minimum 25% latent capacity. We always prefer to keep 25% latent capacity because of that reason. So currently, our utilization is around 65 to 70%, and which every year we intend to increase by 10 to 15%, because the paint industry, which is our basic market, paint and ink, is expected to grow in the range of 10 to 15%, and the top floor players in that segment are expected to grow anything about 20%. So overall, what we feel is in next 3 years, we'll be able to reach our full capacity utilization.
So is it fair to infer that you are given a guidance of, let's say, 10 to 15% of volume growth over FY23, 24, 25? Is it fair to assume that?
We'll obviously, that's what I'm saying, we'll strive our best. It depends, everything depends on how the economy performs at the same time.
Sure, because I must say that the company has done a commendable job, especially in Q1 with getting margins back to 18%. That's fantastic. My other question is, what sort of revenue and margin profile can we expect from the biodiesel project?
That's the biodiesel product will be going in operation by end of this year. And so this year you won't see any major upswing of that. Next year onwards, you will see the advantage coming out of it.
Okay. And but what sort of revenue margin profile can we expect?
It will be certain things. It's basically what we have done is we have a state-of-art plant. We have erected a state-of-art plant, which none of the companies in India is having. So based on which our manufacturing cost is going to be pretty low. But due to keeping in mind the competitive scenario, certain things it won't be fair for me to divulge at this stage.
Okay, I understand. And Noj, I can see that our nutraceutical business has been scaling down from FY18. In the deck that we have shared on the BSC. What are the challenges that has resulted in such a result for the nutraceutical business?
Two things were there. One was that we were concentrating more on our fatty acid stream. That was one thing. Second thing was because of COVID, whatever expansion forward integration project when we were in process of implementing for our nutraceutical division got a little bit stalled because the critical equipments were going to come from abroad. So that was two things. And third thing was there were one or two small players who came in market and started buying material, and which created a little bit of a situation whereby it was unremunerative for us to do the business at that stage. But as our tocopherol forward integration plant is in place, will bounce back in the same scenario, because our we have been supplying this material to 3 US-based giants who control among themselves around 80% of world's market. And again, once our products have also got approved with them, the new product streams also, so we expect to bounce back again.
Okay, so is it what sort of volume?
Volumes would go up. Volumes will go up.
Okay, so this is a rock bottom that we have hit.
Yes, exactly.
Okay, and my last question.
Mr. Shah, I would request you to please read.
Sure. I'll do that. I'll just come back in the queue.
Okay. Ladies and gentlemen, a request to all the participants to limit their questions to 2 per participant. As they have follow-up questions, I would request them to rejoin the queue, please. The next question is from the line of Trilok from Diamond Asia. Please go ahead.
So this is on the expanded capacity that we have seen recently. Is it fair to assume that the historical asset turnover ratio will continue, or do you think because of the recent increase in realization, particularly raw material, that is bound to go up meaningfully versus the history?
Asset to turnover ratio is expected to go up because whatever the expansion we have done doing minimum capex. So obviously, asset turnover ratio is expected to improve every year.
So based on the capex that we did last, about from 90,000 to 120, what sort of peak revenue potential that can we generate from that project?
What kind of peak revenue? What kind?
Peak revenue, so as Nauzi said in response to the previous question, we are likely to achieve the full capacity utilization in next 3 years. So in the terminal year of the 3rd year, we will be achieving the peak revenue. And at current prices, if we assume that whatever is the current prices, we are presently at 65% capacity utilization, and the revenue is 225 crores for this quarter, and the utilization was 65%. And because we are processing these waste products, achieving approximately 92% of the capacity utilization of the installed capacity can be considered to be a fair utilization. So accordingly, we can work out that at 65% if the revenue is 225 crores, and if the present price is sustained over a period of next 2-3 years at 92% capacity utilization, we will achieve that kind of a turnover.
Understood. And sir, with regards to the incremental products that we sort of offer to our clients, so what are we so is the growth rates of 10 to 15% that you highlighted initially every year? 2 questions. One is new products introduction, how much does it play the role? And second is, what sort of market share are we gaining into the products? Could you just talk about it?
See, as I explained earlier, dimer fatty acid, we are the only player in India.
Correct.
So in that case, both these products, what we are manufacturing, are part of the higher economy of the society overall. So, and if typically India is expected to grow at 7%, the top strata of the society is expected to grow at much more than that 7%. So based on that, our assumption is that we'll grow by around 10 to 15% every year. That's the simple logic, and based on that logic only we have created the new capacities.
So, and sir, what is the export sort of growth rate in expectations first in the next couple of years?
We have nutraceutical product is the only thing which is getting exported. And as I explained earlier, we intend to increase our overall share of nutraceutical products in our total sales. So we expect improvement in export earnings.
Are we working at any particular targets in the next 3 years? Nutraceutical business
already we have been exporting the nutraceutical products to 3 US-based companies since last more than 20 years. So that's no new market development or anything to be done. No new customer development. Both the things are not there. Already they are there. So once our plant goes on stream, it will be a smooth sailing for us.
Sure. Thank you. I'll come back in.
Thank you. The next question is from the line of Sunil Jain from Nirmal Bang Securities Private Limited. Please go ahead.
Yeah. Am I audible, sir?
Yes.
Sir, since you are the only producer of Daimler and Linoleic, is that you compete with import, or is there any competing product is there with that, or you're the only supplier for this product in India?
No, we only compete in dimer fatty acid. We only compete. Our competition is from imports, and which is majority coming from China. And we are increasing our market share continuously based on we are competing the Chinese absolutely efficiently, and are in position to increase our market share, which in itself shows that our process or our quality and everything is on par, and we are based on that we can say that we are a competitively priced manufacturer of the said product. And as regards linoleic fatty acid, we are again the only manufacturer. A pseudo linoleic acid is being manufactured by one or two players, which is sold more to the unorganized sector, which is present in paint industry.
So, how much market share you have in this product, and what is the scope?
As linoleic acid, there is none of the big paint companies ever share how much quantity of particular type of decorative paint they are manufactured or they are marketing. It is very tough for us to really get the feel about the market. Actually, what is the market size? But currently, we're at 65%. Whatever we are making, we are able to sell, and the paint industry is expected to grow in the range of 10 to 15%. And so we are also expecting that our sales would be there. We'll be able to sell more than 10 to 15% every year.
So, since you had expanded the capacity very fast, like from 45 to 90 and then now to 120, so that indicates that you must have captured a large market share from the competition. So, is it fair to assume that or no?
No, that is, as I said, that we have captured market share from the Chinese players in dimer. And linoleic acid, what has happened is once the GST came in, the unorganized sector started losing the market to the organized sector. And you can look at the growth of what Asian Paint or Goodlas or Nerolac or Berger are showing. That itself gives an answer. And our product goes to them only. So, that's the proof of the pudding.
Sir, second question relates to earlier your raw material was somewhere you were talking like the waste of oil mills is your raw material. Is it that the same situation, or now the raw material?
No, we are waste products of the vegetable oil refineries are our raw materials, and we intend to remain in that space only because over the period we have created our capacities to process raw material which doesn't have any product specifications, and we are able to manufacture product with stringent product specifications. And so we don't intend to change our raw material from byproducts to prime products.
Okay, and yeah, I agree with you, but the availability of raw material is not an issue.
No, currently it's not an issue, as I explained, that we have capability to process any and every soft oil waste products. So, and India is one of the largest markets for vegetable oil. So, we don't foresee any major raw material constraints.
It's the last question, if you can allow me. FY20 and 21.
Sorry, Mr. Jain, I would request you to.
Yeah, I'll come back in.
Thank you so much. The next question is from the line of Dhavan Shah from ICICI Securities Limited. Please go ahead.
Yeah, thanks for the opportunity, sir. So I have a question on the volumes process. So can you please share the data for this quarter Q1 23, what was the volume processed, and as against the Q4 22? And
annually, so we have been sharing the data. Always we have been sharing the data. As far as this particular quarter is concerned, what we processed was in the range of between 14,000 and 15,000 tons.
And what was the volume? What was the volume?
Volume only. Last year's volume was 59,000, and this year, during the first quarter, we have processed 1/4 of that last year's quantity, between 14,000 and 15,000 metric tons.
Yeah, I was asking about the quarterly number. So in Q4 22 and Q1 22, what was the number against this 14, 15,000?
Q1 22, 23 only.
No. I'm asking against this Q1 23, what was the volume in Q4 22 and Q1 22? If you can help us, so we can get to know about the quarter on quarter.
Q4 21, 22 was the same quantity as Q1 22, 23.
Okay, and Q1 22?
Q1 22 was much lesser, at around 13,000 tons.
Okay, fine. And, given that the edible oil prices were higher during the last quarter, so was there any inventory gains which lifted, the overall gross margins for the quarter?
No. We just see basically as a company, we have a philosophy in mind that we are a manufacturing company and we don't play around any way in commodity pricing. So whatever we purchase, we sell. So there is no gain or loss. We see to it that no gain or loss happens from inventory or finished product. We try our best. Marginal thing plus minus can happen.
Okay. And at the end of Q1, what was the realization? I think because I think oleochemical was contributing roughly 99%. The contribution is the same in the last quarter also, correct?
Yeah.
Okay, fine. And this includes oleo plus nutraceutical, this 15,000 tonnage volume.
Yeah, it includes both.
Okay. And sir, given that the edible oil prices are coming down, so do you still foresee that maybe this FY23 we can end up with the higher YY growth, but on that base, do you foresee the growth can continue? Because I think the volumes are growing at roughly 10-15%, but if the realization fell to around 30-40%, then do you foresee this kind of growth continues, maybe 10-15% on YY basis also continue over this year, in the next year?
See, basically, you'll have to look at it. Please don't look at quarter to quarter. Yes, end of the year, you'll see. You will see the growth, not only because of volume, because of this value also, because during the current financial year, maybe by end of third quarter or fourth quarter, we will be through with these our value-added products streams also. So that will give us additional contribution in top line as well as bottom line also in last quarter of the current financial year. So we are quite hopeful that on an annual basis, we will certainly be better off in terms of top line as well as bottom line.
Okay, sir. That's all from my side. Thank you.
Thank you. The next question is from the line of Neeraj Shah from Exemplar Investment. Please go ahead.
Yeah, thanks for the opportunity. First of all, I would like to applaud the management team led by Mr. Nahush Cheriwala for setting an exceptional example over last decade of how well a capable management can grow a company from just 57 crore revenue to current 643 crore revenue, and from just 10,000 metric ton volume to current almost 60,000 metric ton per annum volume without burdening balance sheet or profit margins. It's really commendable. Now, regarding my queries, out of our 120,000 metric ton per annum capacity, how much is dedicated specifically for processing DOD?
See, basically, the capacity creation what we have done has a swinging ability. So, it's we can swing our equipments from one raw material to second. So, we can process much higher quantities of DOD if it is viable. So, based on that, whichever the business gives us more money is something what we do. and that is the beauty what we have created in the last expansion.
Yeah, so you mean to say that capacities are fungible, but as per your own estimates, because you must be having commitments for your oleochemical business clients also. So in this year and coming 2 years, how much DOD you plan to dedicate specific this capacities to?
See, currently it's you can see around 3 to 4%, which we intend to double up.
Okay. So around 10% maximum DOD you will be able to.
Yeah, but at the same time, what I explained, if my fatty acid business is giving me more money, I might not do that much in DOD then.
Got it.
I mean, it depends. It depends what is giving us money. I mean, it makes more sense. Rather than loving we won't take exit 100% from any product stream. That's all. We'll keep our food there.
Got it. And with respect to our 50% tocopherol product, by when exactly we will be able to produce the seed product in meaningful commercial quantities from current year or from FY24?
We intend to start the plant by December.
By December. And trial runs, you mean to finish by December, or after the trial runs will go on after December?
I mean, it won't take for much for us to, go in full production. Much time, less than a month.
Okay, and my last query was regarding our forward integration.
I'm sorry to interrupt.
Last question, madam.
Okay, proceed.
My last query was regarding our forward integration projects. So what is the approximate market opportunity size in each of the value-added products we plan to manufacture, apart from 50% tocopherol?
And the other is forward integration. What we are doing is a product called monomer fatty acids, which is a co-product coming out of our dimer manufacturing process. And we intend to, forward integration we'll be doing and making 2 products out of it, stearic acid and isostearic acid. Stearic acid has a huge application of more than 2 lakh tons, and isostearic acid is a tailor-made product, and which we intend to export to US and Europe. Already we have started the, pilot plant product approvals are already in place, and we won't see any issue as regards to our exporting full quantity, whatever we'll be manufacturing, because it will be a very small part of global demand.
Okay. Thank you and all the best. I will join back in the queue.
Thank you. A reminder to all the participants to limit their questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. The next question is from the line of Krunal Shah from Enam Investment. Please go ahead. Mr. Shah, I've unmuted your line. Please proceed with your question.
Hello.
Yeah.
You able to hear me?
Yeah.
Yeah, hi. Thank you for the opportunity. My question is in line with the previous participant question. As in isostearic acid, what are the end applications for that?
It finds application in cosmetics, aviation fuel, sunscreen lotions. It's a product which is being consumed in a big way, and the market is also expanding in a big way because it's a green product. Basically, it's being produced from vegetable oil sources, so that's the beauty of the product.
Okay. And the second question is in line with this tocopherol 50% and sterol 90%. How are these 2 products different from what we actually manufacture in nutraceuticals right now? Because we also do tocopherol.
Currently we are manufacturing, exporting a product stream which is mix of both the products. So, and in future, once our expansion, forward integration plant goes operational, we'll be separating both the product streams and making it into separate stream, whereby both of them would find application separately, like sterol 90 for corticosteroids and tocopherol 50 for animal feed and or for manufacturing natural vitamin.
Okay, so you're saying that basically separating that product increases the market opportunity for you in that sense?
Yeah. We will be selling to the 3 US-based players only, to whom we have been selling since years.
Okay, and you said that we already have some contract with the US guys for these products. So have the samples been approved already?
Already.
Okay, got it.
See, basically we started this company with tocopherol business.
Right.
And we have excellent relation, and all the three are Fortune 500 companies.
Okay. And the last question is on the RM side. So we are now like processing. We have the capacity to process 1.2 lakh tons. What's the total RM available in India? Because as per my knowledge, there's a limited capacity for the RM to produce, because only 1.5% of the total output from the oil refineries that we can use. So if you can help me understand what's the total RM opportunity in India.
I mean, currently for whatever we want to sell, we are able to procure the raw material.
Okay.
And the way finished product market is growing, same way the vegetable oil market is also growing. So we don't foresee any issues regards availability of the raw material per se. And we can use a huge basket of different byproducts of different vegetable oils. So I don't see any issues regarding that.
Okay, got it. Thank you so much.
Thank you. The next question is from the line of Ashish Upganlavar from InvestQ Investment Advisors. Please go ahead.
Yes, thank you for the opportunity. So just wanted to understand, there are a few things happening in our company. One is the expansion that is going on. Secondly, the inflation that we've seen in the raw material side. And third is the value-added products basket that will be coming in as we go along. So in all this, I wanted to break it up into what if the RMs come off. Because last time when we, I think, interacted, you said that percentage margins is what we typically tend to look at, not the EBITDA margin, EBITDA rupees per ton absolute kind of numbers. So would it mean that we will be having a lower a lower EBITDA per ton, because if percentage margins are the criteria for us, or this 17-18% EBITDA margin is the figure that one should look at on a sustainable basis for us?
See, as I explained earlier, because of economy of scale kicking in and forward integration of the product streams, we feel this margin will be sustainable in long run.
Okay. So 18% is the band for us, because historically we have done 20% plus also in some time.
Obviously we'll try because see, two things, economy of scale and forward integration, will obviously help us increase these margins to, anything above 18%.
Okay, got it. So, and these value-added products, does it give us better profitability in that sense? That's what you're trying to say? Or it also expands the opportunity for the company to basically have a sustained 25% kind of a growth on the sales front for maybe next 4-5 years?
See, obviously forward integration is going to give us better price realization, because whatever expansion, forward integration we have done in the same plant. We haven't created any new greenfield facility for that. So that is one thing. And second thing is forward integration would keep us ahead of our, future any competition. Currently there is no competition, but in future also if any competition comes, we are way ahead of anyone else. So overall, it's going to give us a good advantage.
Okay, so that 20% plus kind of a number, is it a fair assumption on the top line growth front for the company that way? And because even after the current expansion is exhausted.
We will certainly strive to achieve that number. Okay.
After the current expansion is exhausted, maybe, I'm trying to understand after 3 years what happens after this phase of growth and capacity that has come.
See, EBITDA, Mr. Ashish, you would be better aware because you are in this line. This EBITDA as a percentage would depend on many things. Theoretically, if these raw material prices increase to 2x and correspondingly our finished goods prices also increase on a pro rata basis, then on a percentage terms one cannot expect that the same 17.77% would be there after both these are increased to 2x. But what we are trying to say is that on an annual basis, we will continuously improve on our top line and bottom line numbers.
Sir, my question was on the top line growth, since our capacity is now moving to 1.2 lakh tons. So clearly we have a visible path for the next 3 years. Beyond that, do you think that the growth of that kind is sustainable? Maybe on the volume front, we might grow at 20%.
As you can see, in the last 10 years, we have increased our capacity from 8,000 tons to 1,20,000 tons. As a management, we are continuously working on different products. We have a full-fledged R&D lab, which is manned by around 15 people, and we are working on different products. We are a debt-free company. So obviously, I mean, whatever the cash flow which will be getting generated, we are going to utilize it in some way for growth.
Sure. Got your point. Fine, sir. I'll come back in the queue. Thank you.
Thank you. The next question is from the line of Ritesh from Girik Capital. Please go ahead.
Yeah, sir, thanks for the opportunity. So just wanted to know your input to output ratio. Is there any yield loss, or you get nearly 95% output?
From about these one-page results only, you can work out what is the raw material cost as a percentage to sales.
No, I'm not talking about raw material to as percentage to sales. If you process, say, 100 tons of raw material, do you get the output of 95 tons, or is there?
In terms of quantity, it will be approximately 94 to 96%.
94 to 96%.
Yeah.
Okay. And another question, you use the waste of the edible oil. So what is the price differential between waste of edible oil to, say, edible oil? It would be 10%?
Oh, no, much higher.
Okay.
Much higher.
So say edible oil is, say, 100 rupees a liter, so it would be something like 50-60 rupees for you?
60, 65, 70, depending on which raw material we are using.
Yes, sir. I just want to know the range of the thing.
Yeah, it is much cheaper, much cheaper. That's the advantage, and that's the DNA, and that's the reason we are having this type of EBITDA margins.
Sure,
that is the reason no one else is in this business.
And it's because the raw material is waste, having no product specification. And from there to make a particular, a product of acceptable quality by big players, that's the challenge, and that's the type of plant what we have created, and the process what we have created, and the people who are with us since last more than 20 years have learned and mastered the art. That's the DNA of this company.
Absolute, sir. You do the magic. That's all from my side. Thank you very much, sir.
Thank you. The next question is from the line of Prit Nagar Seth from Wealth Finvisor. Please go ahead.
Yeah, I think most of the questions have been answered. But just one remaining question was that, sir, we were hearing about some kind of sluggishness in demand, say for the month of July and even for August. So how is it for you guys? Are you seeing any slowdown in volumes by some of the players?
No, maybe this might be a cyclical. So that's why I said earlier also. Maybe a particular month might be up and down, which might affect a particular quarter. And what we need to look at is year-to-year performance. And in that, we don't see any drop anyway.
That's great. Thank you. That was the only question.
Thank you. The next question is from the line of Vipul Shah from RW Equities. Please go ahead.
Thank you, sir, for the question. Most of the questions have been answered. Just one question which I had, sir, is in terms of our sales, revenue. How much of the revenue comes? So could you give a high-level sort of understanding of the industry segment from which our revenue flows, sir?
People buy these three prime products: our linoleic acid, which goes in paint, dimer acid, which goes in printing ink and epoxy, etc., and our this nutraceutical. In terms of value, during this quarter one of FY23, in terms of value, their share was nearly 77% for these 3 prime products.
Got it. And sir, another question was, earlier in the call, we mentioned that basically our volumes were more or less similar, in the last quarter of the previous financial year and the first quarter of this financial year. So the jump in the revenue, quarter on quarter, could it be ascribed to the price?
No, there are 2 factors.
Yeah,
there are 2 factors in that, Vipul bhai. Because what we said is that the quantity process was same, but there is a composition of finished product derived from that quantity process. So though the quantity process was same, the volume of the 2 prime products, linoleic acid and dimer acid, both the volumes showed a jump during this quarter vis-a-vis the previous quarter. So the additional sales value achieved during this quarter vis-a-vis immediately preceding quarter is partly because of this higher volume of these 2 prime products also, apart from the higher per unit realization. So it is not only per unit realization increase which has resulted in this rise, it is because of the higher quantity of sale of 2 prime products also during this quarter vis-a-vis immediate preceding quarter.
So basically, sir, it's a mix issue. What I understand from you, sir, is that the mix was favorable in this quarter, and hence, so, sir, the last question is that, we've been operating at a pretty solid steady state range of margins, barring, sir, the second half of last financial year. So could that be also ascribed to a mix issue, or is there any specific reason you want to call out, sir? Although I understand this is the first quarter call, but pardon me for this question, sir.
Yeah, I will tell you. During that October-March period, if you remember, there was a lot of volatility because of this change in policy during the 6-month period at different points of time. There was change in policy by Indonesia and Malaysia as far as their palm oil export is concerned. There was this Russia-Ukraine war announcement or war between Russia and Ukraine, which disrupted the supply of sunflower oil, etc., etc. So Indian oil demand, which comprises of many things, domestic production plus import of sunflower oil from Ukraine, Russia, import of palm oil from Indonesia, Malaysia, etc. When there is a perception that this import will not take place, the prices would be jumping. And when the prices jump, everything then is in a turmoil. And the end users of our product, these paint companies, etc., then they would take their decision whether to use up their inventory or to create or maintain that level of inventory by buying fresh. So those kinds of things happened during that particular 6 months, and that is how it was impacted. See, after these things stabilized during the first quarter, we have again bounced back to our original level.
Thank you so much, Rajan bhai. I appreciate your candor.
Thank you.
Thank you.
The next question is from the line of Sanchit Agarwal from Littlemore Investment. Please go ahead.
Yeah, thank you for the opportunity and congratulations to the management for the excellent quarter one numbers. My question is so your top customer accounts for 40% of your revenue. So what has been the past track record for 3 to 5 years? What's the growth in that customer?
Yeah, this 40% revenue is during the financial year 2021 and 21-22. Before that, this top customer did not contribute 40%. So this 40% is for last 2 financial years only, and to an extent it will be there during current financial year. Though it may not be 40%, it will be lesser than that. But once we are through with these our value-added product streams, etc., and capacity expansion, and with our focus on these other products also, this contribution of for top customer from 40% is bound to reduce substantially.
Okay, thank you.
Thank you. The next question is from the line of Jagveer Singh from Shade Capital. Please go ahead.
Yeah, good afternoon, sir. I have only one question. Earlier in the presentations, you were talking about sustainable margins of 16 to 17%. So now you are talking to the margins 18% plus. So what has changed in between?
Two things: capacity expansion, which has kicked in the economy of scale and forward integration of products. Two things. Based on that, we feel that we'll be able to improve that.
Okay. And one question, in the Q4, we have hit the lowest margin, around 10% margin in the Q4 last year. So what has changed in these 2-3 months, 10% to 17.7%?
No, last year COVID thing was also there. So I mean,
Q4 last year.
That affected our Omicron and Delta variant things. That's why things were topsy-turvy. So I mean that also affected our things, whereby we had to keep plant shut for longer period, and lots of things were kicked in. So I mean that's not an. I mean I won't put it as a quarter which should be really looked at.
Part of the game. Thank you, sir. Thank you, sir.
Thank you. The next question is from the line of Sagar from Dr. Sagar RV. Please go ahead.
Hi, am I audible?
Yeah.
Okay, great. First of all, I just wanted to congratulate the management because we can see several costs like power costs are still extremely high, but the management did everything perfectly. So really thank you for that. I had just two questions. The first one was regarding our suppliers and customers. Can you just explain how do these contracts work? Because we've seen in many chemical companies, they can't pass these increased costs to their customers. So can you explain how do we buy these raw materials first and then sell it to the customers? Like how do these contracts work, and can we pass the price hikes easily in 1 or 2 quarters?
As I explained earlier that we don't play in commodity. We are a manufacturing company. That's what our belief is. So we typically enter in contracts for raw materials purchase which are not beyond 1 month, and same way we don't enter in any contracts for sales beyond 1 month. Yes, there as our raw materials, commodities, and our finished products are sold on B2B basis, there can be some lag of transferring the increase of raw materials. Beyond that, beyond month or month and a half, beyond that nothing is there. So I mean we'll be easily able to we are in position to transfer the price hikes. But if for whatever reason if there is sudden price hike of 20% or 25%, then because of keeping our long-term relation with our suppliers, they might request us to stagger the hike and spread it over 2 months. Beyond that, nothing.
Okay, so 2 months would be the max. That's really helpful. And my second question was actually a bit more about the future, because right now we are operating this one plant. Let's imagine, because now we have more products coming in, and let's imagine we come with a new plant. What would become the hurdle rate for you? So when you launch a new product, your focus is on margins, what's the payback period? Which is the metric you like to focus on, just to understand how the company grows from there?
See, as regards the forward integration of the 2 product streams, one is in the nutraceutical field, which product we are going to manufacture and are going to sell to the same customers, and which has already been approved. So we don't see any hurdle in that. And as regards the new product called isostearic acid, initially, it might take already the pilot plant samples are under approvals, and the results are quite encouraging. And in that case, we also don't see any big hurdle, because it's a green chemical and world is going green. And the market is also, isostearic market is also growing at a fast pace. So we don't foresee any major hurdle in that area also. And over the period, we have created a name as regards the quality soft oil manufacturer. And companies know about us. And so, we don't see any major issues regarding that.
If I can just clarify one thing, what I meant by hurdle rate was, let's imagine we come up with a new plant, for example, you'd be focusing on higher margins compared to existing products, like that concentrated tocopherols you were mentioning. Yes.
Obviously. That the forward
Okay.
integration logic was that only to have better price realization.
Perfect. Thank you so much. That's really helpful. An amazing job.
There is a follow-up question from the line of Raj Shah from Stetheris LLP. Please go ahead.
Yeah, but I don't really have any questions, but I'd like to, wish all the luck to Rajendra and Naosh. Thanks a lot.
What was that?
Mr. Shah, can you please repeat your question, please?
Hello, am I audible?
Yeah.
Yeah, I don't. The questions that I have were taken up by the previous participants. I'd like to congratulate and wish luck to Naosh and Rajan. Thank you so much for the call.
Thank you. There is a follow-up question from the line of Neeraj Shah from Exemplar Investment. Please go ahead.
Yeah, thanks. Just one follow-up. What has been the contribution of dimer acid to our FY22 revenues?
Dimer acid, all these prime products put together were approximately for the financial year 21-22, that contribution was around 73%, all the three prime products put together.
All the three products, and a particular dimer acid, if you can share?
Dimer acid would be approximately 30-35%.
30-35%. Okay. Thank you. Yeah, rough estimate, no?
Yeah.
Okay. Thank you very much.
Thank you. There is a follow-up question from the line of Sunil Jain from Nirmal Bang Securities. Please go ahead.
Yeah. So you said that Q1 production was around 14,000 to 15,000. And you said that the capacity utilization was 65 to 70%. That doesn't match because you now capacity.
Because additional capacity was created by end of June 2022. Okay. During the quarter of April to June, the capacity was 90,000 tons only.
Okay. So this additional capacity can be utilized in the current year.
It was in place in the end June 2022, 30th June 2022 only.
Okay.
So we have for the quarter April June we have applied this percentage of 64% on 90,000 tons capacity because that was in place at that time.
Okay. Fine, sir. Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would now hand the conference over to the management for closing comments.
Thank you all for participating in this earnings call. I hope we were able to answer your questions satisfactorily. At the same time, offer some insight in our business. If you have any further questions or would like to know about the company, please reach out to our investor relation manager at Valorum Advisors. Thank you. Stay safe. Stay healthy.
Thank you, everybody.
Thank you. On behalf of Valorum Advisors, that concludes this conference. Thank you for joining us, and you may now disconnect your line.